the next question we will talk about is the active management strategy. How many strategies we can construct our active portfolio? So the first group is called the fundamental strategy. For the fundamental strategy, we have the top-down to bottom-up. So for the top-down, I think you have learned that before. If you are doing any stock evaluation or stock analysis, the top-down means you begin with the microeconomic analysis, and then you go to the industry analysis. Then finally, you have the security analysis. So that's the top-down. And the similar idea for the top-down in active management strategy. And first step, you need to analyze the whole market situation, and you allocate your money between different asset class, like in bond portfolio, in equity, or in cash, how much money you want to invest. So that's your asset class rotation. And then you need to decide what's the sector rotation. Sector rotation means which sector or industry you want to overweight and what kind of sector you want to underweight. So you need to decide that. So finally, you need to make any individual stocks selection. So that's the top-down method. And the next one is the bottom-up. So what's the meaning for bottom-up? In English, the bottom-up means the cheers. So if you cheers with others, you can say bottom-up. So this bottom-up means you do the stock analyze first. So you do not consider any asset class rotation or sector rotation. You only consider the stocks first. You want to find which stocks is undervalued, and then you buy it, and which stock is overvalued, you can do in any short selling for it. So that's the bottom-up method. And the second group for active management strategy called technical strategy. For technical strategy, we have two different strategies. One is called contrarian, the other is momental. So let's have a look at them each one by one. Now let's have a look at the technical strategy. And the first I want to show you is the momental strategy, or we can call the price momental strategy. We learned that before in the previous lecture, the multi-factor model. We introduced the momental factor in Carhart 4-factor models. So I think you should understand what's the momental, but now here we continue to talk about this price momental strategy. So if you are assuming it is the momental strategy used for, which means you assume that recent trend in past price will continue. That means the stocks increase will continue increase. So hot is still hot. And this momental strategy will focus on the trend of past price alone and make purchase and sell decision accordingly. So that's the momental strategy. But opposite to this momental strategy, the mutual fund manager, they might have the different strategy, which called the contrarian investment strategy. So in this contrarian investment strategy, the mutual fund manager or the investor believe that the best time to buy or sell a stock is when the majority of other investors are the most bearish or bullish about it. In other words, if the stock price decrease and in the next period, definitely it will increase. So we will find this undervalued stock and investor now. So that's the contrarian investment strategy. So these two strategies is the opposite assumption. And for the contrarian strategy, we assume it is a mean reverting trend. So what's the meaning of this mean reverting? Let's have a look. I will show you a graph that if this denotes the stock price, So if this is the stock price, you can calculate based on different time period, the mean for this stock price is this horizontal line. So mean reverting means that if you find the stock price is here, if you assume it is mean reverting, definitely the next period or in the following period, it will go back to our mean. So the stock price will go down. But if you find that the stock price is here, and you assume the mean reverting, you will find that the next following period, your stock price will go up. So that's two different concepts for your investment. And for this contrary investment strategy, it is kind of an overreaction hypothesis. So here we may think all the investor is overreact for the news about this stock price, and it will goes back. But compare with that, if we are thinking about a momentum strategy, we think the past price trend will continue, which means we are underreact the news for the stock price. So that's the difference strategy for technical strategy, which are contrary and price momentum. Now let's go back to the third categories for our active management strategy, which are market anomalies and security attributes. For the market anomalies, we have the calendar effect, like weekend effect and January effect. You have learned all this effect in the efficient market hypothesis. The second one is security characteristic, like size, P ratio, PB ratio, etc. And last one is investment style, like value versus growth stocks. So based on this market anomalies and security attribution, we can do our active portfolio management. Like this style or the security characteristic, we can do our factor models to selecting which factor may contribute more about our return, and using this factor model to doing any investment. So that's the market anomalies. Now let's have a look at the investment style. For the investment style, as I mentioned, the value stock versus the growth stock. So I think now you should understand what's the value stock, what's the growth stock. But now we need to compare what's the difference between the investor if they have the growth-oriented view and value-oriented view. So let's have a look. Let's think about if we analyze our stock based on PE ratio. Let's have a look. Based on the growth-oriented investor, it will focus on earning per share. So they will first focus on this earning per share and its economic determination. Look for a company expect to have rapid earning per share growth. And sometimes they assume that this PE ratio is constant. So if you assume this PE ratio is constant and you expect the earning per share is increased, definitely the price will increase. So you will find these stocks which will have a higher price. Opposite to growth-oriented investor, the value-oriented investor will focus on the price component. So they will focus on this P and not care about the current earning. The earning per share is not relevant. And they will assume that the PE ratio is below its natural level. So if it is below the natural level, the next period definitely it will go back. It's mean reverting. So if it is go back, and the price definitely need to goes up. So that's the two intuition behind these two methods, the growth-oriented and value-oriented, to select the stock. Now let's have a look at the second one. And for the value stock and growth stock, we compare them together. A growth investor focuses on the current and future economic story of the company with less regard to share valuation. And a value investor focuses on share price in anticipation of market correction. And possibly improving company fundamental. So that's the big difference between the investor to select the stock based on the growth-oriented or the value-oriented view. And the next point is the value stock generally have offered somewhat higher return than growth rate. From the previous literature, we know that there is 3 conclusions that the value stock works better than growth stock, has a higher return. The small cap stock works better than big cap, so have higher return. And the last one is the momentum stock, it works better. So here we know the value stock, which has a lower PE ratio and lower PB ratio, works better, has a higher return. But this does not occur with much consistency from one investment period to another. So at a different period, maybe not always value stock works better than the growth stock. But generally, if your time period is much longer, so we will have this conclusion. And give you an example in China, in 2014, that period, and we have value stock works better. But in 2017, the first half year of 2017, the growth stock was better, and the second half of 2017 and 2018, the value stocks work better. So different period maybe have the different conclusion. And the value stock are relatively cheap and have modest growth opportunity. Growth stock tend to be more expensive, reflecting their superior earning potential. So generally speaking, the value stock might have maybe cheap. So if you want to invest in the long term, you can choose some value stock which are undervalued and keep it longer times, you will definitely earn the value. So that's the idea for most mutual funds in US. The last slide, we will talk about the style analysis. For the style analysis, we have discussed it before in the previous chapter, in chapter 6 for the multi-factor model. So in that part, we talk about the style risk factor, include like the value, growth, and volatility, and liquidity, and beta, etc. So here, in this case, we just gave you 2 style factors. We use one is based on the size factor, the small capitalization, and to the large capitalization, and the other is the value stock to the growth stock. So construct this portfolio, capture these 2 characteristics of equity security. We can separate it for this style analyst grade. So let's have a look. We have the large cap, and this one is the value stock. And also we have the large cap with the blend. So blend is between this value and the growth stock. And this part is large cap with growth. So opposite that, it is a small cap with growth and small cap for the value stock. And then I will summarize some index and put them in this grade. So let's have a look. The first one is SP500. For SP500, we just select the top 500 stocks which has the largest market capitalization in US market. So we put it in this large cap. And for SP500, this market index, it includes both value stock and growth stock, so we put it in the blend, so it in this part. And for Russell 1000, that is based on the Russell 3000. So from these 3,000 stocks, we choose the top 1,000 stocks, which has the largest market capitalization. So Russell 1000 is on the top of Russell 3000. It's also in this part, the large cap and blend. And here is R1V. This means the Russell 1000 value stock. So this is a new market index, which is also the Russell 1000, but now it is the value stock. So in this case, we put it in the large cap value. And opposite that, we have R1G, which is Russell 1000 growth stocks, so we'll put it here. And the other is the NASDAQ. For the NASDAQ is definitely the growth stock, so we put it in the growth stock and also the mid cap, the small, a little bit small size, so it's in the middle part of the size factor. And for the S&P mid cap is in the middle of it, and the Russell 2000. So what's the meaning of Russell 2000? Russell 2000 is the 2,000 stocks, which also choose from this Russell 3000, 3,000 stocks. And but now this 2,000 stocks has the this 2,000 stock has the smallest market cap, so we put here. So that's all the style analysis. In Farmer French 3-factor model, it also uses kind of this style analysis grid and separate the small and large cap and also value growth stocks in different groups to construct our portfolio. So that's all about the style analysis. In this class, we introduce the active portfolio management, introduce what's the active portfolio management and what's the active return and active risk, and how can we doing active portfolio construction. So that's all for today's class. Thank you for your listening.